G'day, I'm Jonathan Bayes. It's the 8th of July and some comments on portfolios and markets from the week we've just had and looking forward. The grind high continued last week, helped by the Reserve Bank cutting interest rates as expected to 1%. The passage of the income tax cuts being another positive for markets. And so we find ourselves here in the middle part of July with the Aussie share market up a whopping 22, almost 23% year to date with dividends, which is a fantastic effort. But I think globally as well as locally, we're going to start facing a few trickier weeks to come. Reporting season we've talked about likely to be a little bit harder because the underlying economy, both in the United States, China, and in Australia, is certainly not strong. And we also have just a bit of expectation management for investors too. You know, the RBA last week cut rates, but they also inferred that they were going to hold off for a couple of months to see the economy perform before cutting again. On Friday in the United States, we saw a bit of a backup in yields because the jobs market, believe it or not, was stronger than expected. So all of the expectations for 4 rate cuts in the United States in the coming 12 months started to wind back a little bit from really very optimistic levels. And so it might be just a case that reality bites, particularly with markets as high as they are. And as a result, we might be looking at the back end of winter our time and summer in the Northern Hemisphere where markets consolidate, but doesn't mean that they have to fall materially from here, but certainly consolidate. I would say that within the internals of the market, there are some real opportunities starting to emerge. Market is chasing momentum at the moment in a big way, and certainly Australia has been affected by that. Some big cap and small cap stocks are trading to multiples that look, to me anyway, beyond the next couple of months, pretty unsustainable. CBA is back at its PE high now on current earnings of just on 17 times, which is incredible when you consider that interest rate cuts obviously have a big impact on the earnings capability of the banking sector. Woolworths surged last week on news that they were going to de-merge their liquor business. That includes exposure to hotel operating licenses that have poker machines in them. It's a good move, but the market pushed Woolworths higher to a multiple which I find staggering of 24, 25 times earnings. And I can assure you that I think the demerger will be value destructive. I can't see investors paying the same sort of multiple that Woolworths trades on now for the soon-to-be demerged Endeavour Liquor Group business, particularly with concerns about upping regulation on gaming. So that's an odd one. Magellan had a great set of numbers on assets under management last month, up just under 5%, phenomenal effort, but that now trades on 25 times earnings and is one of the most expensive traditional asset managers globally as we speak. Think about 18 months ago when people were questioning the Magellan global equity performance. But 25 times earnings for what is not one-dimensional. It's a wonderful business and a credit to the guys running it. But it is largely a global equities business there, and that's where the focus has been. So it's a huge multiple. But you know, healthcare stocks trading on record multiples, despite the fact that we're going to go into an election cycle in the United States, and it seems that there is bipartisan support for lowering the cost of healthcare in the United States. So you wonder when CSL and Cochlear and ResMed are going to see some weakness coming through. And yet on the other side, there's just tremendous value in a whole heap of broken stocks within the financial services sector. We've talked about IOOF. Challenger, I think, just looks amazing from longer-term value standpoint. In the agricultural sector, Nufarm saw some takeover rumours last week, pushed the stock higher. But we do think that there are some real opportunities, certainly within our portfolio, in some lesser light stocks that hopefully will provide us some good performance in the coming couple of months, whether the market goes up or down. Anyway, that's it from me.